Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, and today we're continuing week number 3 of the 52-week review of our 2026 weekly dividend ETF challenge. So as you know, we bought $10,000 worth of weekly dividends, 10 different funds, invested my own money into this to show can you make money from it, or are they so high risk that we really just can't do it properly? Let's get into the update for week number 3 on how well it has done. So before we get started, we have to do the investment disclaimer and the risk warning that this video is not for financial advice. This channel is purely based on my own thoughts as I navigate my personal investment journey. Please always do your own research before investing in any single stock ETF. I am not a licensed financial advisor. If you need financial help, always contact a financial advisor, as I am not liable for any investment decisions that you have to make based on this information going forward. Let's get into the breakdown. So, the 2026 Dividend ETF Challenge is the high risk, high reward experiment to beat the market with leverage ETFs. Now, to give you some, update and redo of what we have, our strategy outlay is we're putting $10,000 of our own money across 10 different ETFs for a total of investment of $1,000 in each. Our goal is the weekly dividends, and we're trying to get some growth in the stock across the board. So the hypothetical goal of the challenge is try to achieve a weekly income of 25%, a total return of 31%, and a growth fund of 6%. Now, we chose not to do drip, but because of what you guys all said, you wanted to see it, we do it a synthetic type blend with dripping allowed. It's not that we're dripping our money. What we're doing is we're doing a math calculation. I'll show you that here shortly. Now, the risk factors of this: leverage ETFs amplify both the gains and the losses, and it concentrates on the portfolio, increases volatility, and the option-based strategies. And the tracking approach is, like I told you, we were going to show you weekly dividend tracking, real-time performance monitoring, and give you basically the viewer feedback incorporated into it. Already, you guys asked us for drip. We're doing drip. If you guys tell us something different, we're going to try to add it into it. And I have to say again that this is not financial advice. I'm investing my own money and showing you what I'm doing with that money as we go through this. And if you haven't seen it, but what we did, and I'll actually post the very first version of this in the comments so you guys can quickly see it and get caught up. But our final portfolio is that we did a broad across that we used Roundhill, Yield Max, Rex shares, even Granite shares across the board. We tried to do things equally. We did not try to duplicate everything goes into AI or everything goes into tech or everything goes into Tesla. We tried to spread it out. And, honestly, it was a tough thing to do because I felt that we had more room to play with, that we didn't get the stuff like Amazon and some of the retail stuff. But what we got here, as you can see, we took $1,000 in each fund. We got number of shares, the price that we paid. And some of the things that I was excited about, AMD was one of them, Google's another one, the gold side of things was another one. So we have a lot of pieces of the puzzle. Also, we put that TDAC and TSYX put into that one, and just try to get that leverage of those two new funds. So let's take a look at how we did. So I have to report we sold HOOW, the Roundhill Robinhood Weekly Pay ETF. It just, bottom line, guys, I asked you last week what you thought, and I just put it this way. It hit my total return negative number. It went below 30%, hit 31.59%, and I just said it was time. It was over with. The assets under management dropped to ridiculously low numbers. And I was not going to hold out longer on this one to say, oh, we're going to have some recovery, something's going to happen. I just, unfortunately, I've been with this fund almost since it came out. I was excited about it. I thought Robinhood would continue doing a decent job. I know it's built a lot around the crypto market and so on, but I just thought it would break itself out. But after losing in this portfolio $360 or 36%, I said, you got to cut your losses. It's time to move on and make up on something else. So officially, we have had our first victim. We sold our Robinhood, and we're putting it into other markets. So the fund selection for this week changed a little bit. You look at the very bottom. We put the money into the Tesla, RexShares Tesla 50/50 program. Now, I'm going to say I still have $1,000 invested into it because all we did was we sold our Robinhood, got about $640 out of it. We took that money, bought as many shares of the Tesla as we could, got us about 29 shares. And, it actually had since buying it, it has gone up a little bit. We did not buy it to get into the dividend. We'll get that next week. So, it's got room that it has to build some profitability. It's got to rebound for what we lost in Robinhood. Kind of how the structure is going to be, and just see if this thing can really pull itself out. But across the board, we take a look at, our highest dividend again was AMDW, and they are down. This has not been a good week. I will tell you this. You're probably realizing it's not been a great week for what we've done. When we take a look at this thing, you'll see for week number 4, our portfolio is down to $8,598. That is $1,401 loss, or 14% lost already in the total value of our fund. Now, we were able to collect $100.70, which is about 1.01% in dividends, which is the highest that we've had so far. So I'm very pleased with that one so far, getting about I think right now we're going to be about an average of about $90 per week. So our dividends are slowly coming up. We've collected $875 in dividends for 8.76%. But our total return, remember, we do everything by total return. If you ever hear me say anything other than total return on this channel, you have full right to leave a comment below and say, follow your own truth. And my truth is this: total return is what means everything to this fund. And that is, we're down $525.54 so far. 360 of it is HOOW alone. So we're down 5.26%. When you look at the total value across the board, everybody is out, other than really 2 funds, are over that $1,000 initial investment. So after 4 weeks, I clearly say, just buying this and taking the money off the table and using it for yourself, it's not working. It's not performing so far. We do have a lot of time left in the year to go through this, and we are going to do this for 52 weeks. We'll make adjustments as we need to, but bottom line, this a standalone type program just does not work. Let's take a look at what we did in the DRIP fund. Same thing. We have taken the money off the table for Robinhood. We've put it into the TSII. It's going to have to make up for its difference. Dividends, we're up to 105. So we're actually $5.83 more than we are with non-DRIP. So we're seeing some big changes there. The fund is not down as bad. It's down $8,895. So it's holding a little bit more, still down 11%. Distributions are higher, 8.76, and our total return is down to $228.90, so down 2.29%. So even at 100% drip on all of these funds, we're still in the red. We're still negative on these, and for our goals that we established, this is not looking as well as we were hoping to. A market turnaround is what everyone always talks about. Man, if we could get a market turnaround, the prices could go up. But we need to get some dividends built into this fund to help try to develop that down the road. Now let's take a look at the data for each one of the funds. Now there's some things here that are starting to, again, it comes in my wheelhouse as I call it a warning sign. You look at all the funds that are down in their assets under management. The first big one, AMDW, dropped $13 million. And with that, I'm going to jump right over. Their total return went negative. Went from a positive 12% down to a negative 4.21%. Google, it held pretty much, I'd say it's staying. It's a slightly up. But again, its total returns dropped down 6 percentage points. The gold miners, it dropped $2 million drop off. But their total return is up 14.9. It's to 14.93. So that's up 3.9 percentage points. Robinhood, this was the deciding factor for me when I saw the new assets under management. We dropped another almost $80 million. How much longer can you continue doing that? That's my question to it. And down to a negative 31% in the total return. I said, this is it. We have to get out of this fund. The NVIDIA program lost a little bit, about $9 million there. They went negative in their total return. Eli Lilly actually added some, so I was positive with that, and that's slowly coming out of its negative total return. Chippy. Now, this is probably, I'm going to say, the number one fund across the board. I'm very pleased with what Chippy's doing, up $16 million in revenue, in assets under management. It went from 11.59 to a 12.34%, and it still has a 0.88% on the dividend yield. TSYY, the Tesla, dropped. TDAC is up, and the TSPYX is definitely went up almost $4 million in assets. So it's starting to take hold right there. So across the board, guys, these are the numbers. Like I said, when you see a drop off in assets under management, it starts a warning sign. When you see total returns drop off, it's your second major warning sign. When you see the dividends coming into play, it's your third warning sign. And with HOW, HOW, it was warning sign after warning sign after warning sign. And once I hit my mark, and this is something I always tell people to have too, is always have an exit plan. Have an exit plan when you buy something. And my exit plan broke. When it broke, I was done. Now, do I worry about these other ones? Not just yet. It's something to keep a look at, and that's why I do this in this type of a spreadsheet and this type of report. I'll look at this and say, okay, is AMDW going down again? I think that's part of the AI bubble, the AI tech market that caused some issues there, but we'll keep an eye onto it. We'll keep an eye on basically on the four that we have left in the marketplace. The other ones, we're going to let them continue on. So our recap, kind of a new week, new winners. This is kind of interesting. The gold GDXW moved to the top of the total winners market again. Total return winner, 14.93. Chippy is held in there at 12.35, and Google stepped in at 3.65, basically knocking off AMDW. They went from number one and out the door. Yield winners. The TSYY will always be the number one winner there because of the way their system is set up at 2.59%. AMDW at 1.89, and HOOW was at 1.44 when we received and got rid of it. Total value winners, we're at $5.94 with the Gold X. Chippy is at $1.89, and TSYX is down $13, still making the winner board in a negative number. These are our recaps. These are our big supplies. After 4 weeks of this, you're starting to see some interesting numbers here. You're starting to see some things play, and we'll keep you up to date. So we'll see you next Monday. So quickly is call for any feedback in the next steps. We've selected our ETFs, as we said. We're going to always ask this: there's one you think we should be swapping out? Should we something new that's on the horizon that you think was doing well? Should we add the YMAX, the YMAG into it? The drip strategy. We did this. You guys asked for it. We did it. And again, series interest, we're going to continue doing this across the board. I want to thank you for your input. I love what you have. Leave the comments below. I know this is a short, quick video, but let's see how we do next week, and we'll see you then.